Personal finance practice problem using OneNote. Calculate APR and payment for a home loan. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 5162 Calculate APR and Payment Home Loan tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're looking at the APR, the annual percentage rate. This is a rate often different than the interest rate that's going to try to wrap in the interest and fees that will be involved on it, so we can make a better comparison between different types of loans. So for example, when we're thinking about different loans, there's a couple things that can be confusing to us. We can think of as the person giving the loan intentionally trying to confuse us, or even if presenting the information fairly and accurately and trying to communicate, we could still get confused by a couple different things with regards to loans in general. One being that oftentimes they might try to represent the interest rate in different than a yearly terms. So they could represent it on a monthly term or some other term. That's not normally going to be the case when you're looking at home loans, because the convention typically will be, and generally for all loans, the convention is to represent the interest on a yearly basis. When we do the calculations, we'll have to break that down to a monthly basis for the purposes of the calculation, but we should have some standardization, at least from the home loan, with regards to the interest rate on a yearly basis. Then we also have the information or some kind of confusion that could result in the difference between how they're going to get paid for providing the loan, for providing us the purchasing power of the money, either through the charging of kind of like rent on the purchasing power, which would be the interest on it, which would be the typical thing we think of, or they give us fees. They just charge us fees on it. And if they charge us fees, the simplest way that they could do that is they could just tack the fee on to the loan itself. So in that instance, you would imagine a situation, for example, here, we're taking a $100,000 loan. If they were to charge us a fee, they then would say, you need the $100,000 possibly to pay the purchase to purchase the home. And then you're going to pay us or the loan organizer the fee up front of another $1,000. Therefore, your actual loan is now going to be $1,001 that you're then going to be taking over the life of the loan. Now, we can see how that would work fairly easily, but notice now we have the same 7% interest, but this one, the second one, now has closing fees, or has fees added to it. And how would we basically calculate this? And this one, clearly, the second option would be worse because we have the same interest rate, but then we have the fees. But if we had a situation, for example, where this one had a lower interest rate and we had the fees, that could be confusing. How can I compare something that has a lower interest rate, but then they charged me these fees, to something over here that doesn't have any fees, but they have a higher interest rate, for example? And you can see where that the confusion could come in. The APR is something that should help us with that. It's not the ultimate thing either, because we could still end up with situations where we would go with the higher APR possibly. And those instances with regards to a home loan might be instances where we're not having the home for the full 30 years. We'll talk more about that in the future. But generally, if we're staying in the home for the whole time period, we're thinking, how can we roll in this $1,000 to a rate? Because we know that we can compare ratios and rates a lot more easily so we can compare the same thing to the same thing. That's going to be our attempt here. So let's calculate the first one we'll look at it without basically any costs first and do our amortization table, our payments calculation, and then we'll add the costs and do the APR, which will then have a different interest rate to the APR. So this one, first off, we don't have any costs. Therefore, the interest will be the same as the APR, and you can run basically a payment calculation on it. So we have the $100,000 loan, no costs added, interest rate 7%, years are 30. So then if we want to be picking up the number of periods that are going to be covered, because they're going to be monthly payments that we'll have on a typical 30-year loan, we would then have the 30 periods times 12, or 360 in terms of the periods that would be covered. Now then we would have the standard payment calculation. Typically to calculate the payments, we would of course want to be doing this on our own, be able to do this on our own, so we can compare and contrast different loans on our own. And Excel is a great tool to do this. We do this work in Excel if you want to take a look at that. And also, these are basically looking at time value of money calculations. So if you want to get a better idea of time value of money calculations, take a look at the prior section where we focus on that in detail. Here, we're just going to run the payment calculation, standard payment calculation. I'm going to say negative and then the payment. You could put the negative inside the formula in here, which would actually probably be more proper. I like to put it outside when I can, so that's what I do here. If you don't put a negative in there, I think it'll still give you a result, but it will be negative. And then we've got the rate, so which is the 7%. And then 0.07 divided by 12 gives us the monthly rate. You can see the monthly rate is quite small, which is one reason we don't communicate the monthly rate. But when doing the calculation, you can see we are in essence using the monthly rate, which isn't a problem because we'll just reference the cell, even though it's a very ugly number to work with. Comma, the number of periods would be the 30 years times 12 because we're talking monthly periods, or 360. And then the present value would be the 100,000 loan plus any costs. There aren't any costs. So simply this time the 100,000 will add the costs next time. And that would give us the 66530. Now you can do online calculators to help you out with this, but also note that it's nice to be able to run a table, an amortization table with this. So we'll practice just looking at one here. You could generate an amortization table from some of the online kind of sources as well, but you have a lot more flexibility to work with this stuff in Excel. So I would use the online calculations as a double check to what you're doing in Excel. In essence, the online calculation would look something like this, right? This is just one online calculator you can look at. $100,000 loan, term, we're going to say 30, rate is going to be the 7%, and we're going to say, I'm going to put 0.01 because they require a value for no costs here. And then we can run this, and it should give us then our amount of the payments. There we have the 66530, and you can see an amortization table, and this is what we'll basically build here with our amortization table back. So we got this 66530, and so that is that what we got? Yeah, 66530. So you can kind of match it out there. Now I'll just take a look at the amortization table fairly quickly. Notice if you enter your information in this way up top in your Excel worksheet, you could change the data then and manipulate your data easily. And I still think it's easier than the online calculators as well. And you could save your stuff a little bit more easily and whatnot, I believe. So in any case, then we've got the 100,000. If you were to look at your periods, there's a lot of periods, 360, but that's easy to copy and paste down if you're using something like Excel. And the payments then are going to be a 665, which I've rounded now and took the pennies off. And the interest calculation, if we calculated this out, would be the 100,000 times the rate of 0.07. And that would be for a year. So we got to divide that by 12, and that would give us about that 583. And so if we take the full payment of the 665 minus the 583, we have a difference of 82. If we take the 100,000 minus the 82, then we get that 99918. We can continue this process down. It looks like you get to the same numbers because it's such a long loan, but obviously the difference between the interest and the reduction of the principal will change drastically once you get to the end of the loan, way out, closer to the 30-year time period. So if we did that one more time, you would say 99918 times 0.07, and then divide that by 12. That would give us about that 583, which you get the same kind of 665 minus the 583 is the 82, about rounded. 99918 minus the 82 would give us about this amount. If we did this all the way down for 360, and you can copy it down in Excel, it's fairly easy to do, the bottom line number should then get to 0. So we have the 0 down here, and you can verify your totals. If we totaled up the payments and the interest is 139,509. And so we can kind of look at our calculator here. We got the 139,509 about for the total interest. Total payments are at the 239,508. So we have then here the 239,509 about. So then let's do the same thing. Now we're going to be adding the closing costs. So now we got the same scenario, but we got these closing amounts. Interest rate now is going to be different than the APR. So one way we can calculate this, I think this is one of the most intuitive ways to do it in Excel, is we're going to do the payment calculation. Now when we do the payment, note that what happened is, you can imagine, okay, we took out a loan, we're going to pay $100,000 in order to help us to pay for the loan itself, to pay for the home. And then when they issued the loan, they want another $1,000 up front. They want to take the money right then and there now. So they're going to take the money and then charge us for our loan, tacking it on to the loan balance. So now our loan is at $101,000. So we're going to be paying off the loan plus that $1,000 over the 30-year time period that we have. So that's going to be basically the idea of it. So if we do our payment, then it's going to be the same payment calculation, but now we've got a larger loan amount. So we got the payment, negative payment. The rate is still the 7%. We're going to divide it by 12 to give us that monthly rate. Same thing there, comma. Number of periods is still 360, which is 30 times 12. And then comma. Now the present value, though, now does have an added value. The present value, not just the loan of 100, but 101,000. So that then gives us slightly different, the 671.96, as opposed to what we had before, way up here, 665.30. Let's go way back down. So then what we want to do is calculate the APR. So we can do this on a monthly APR. We can use a rate type of calculation to get the monthly APR. So we'd say equals rate, brackets, number of periods, once again 360, comma, the payment would be a negative when we need to put the negative inside here, or else it gives us a value that doesn't give us a value. So we're going to say the payment is going to be this number that we just calculated, the 671.96, and then the present value, you would think, if we used, in other words, the present value of the same amount, 101, that we used to get the payment, we would get back to the 7% interest. But we're not looking for interest, we're looking for APR. So what we're going to do is say that the present value represents the 100,000, not including the closing costs, and that will give us the monthly amount of the 0.59157 and so on. If we take that amount and convert it to a yearly amount by simply multiplying it times 12, in other words, we take the 0.0059157 about times 12, we would get about the 7.099. Now the APR is 7.099, which is always going to be higher than the interest rate. So it's always going to be higher than the interest rate, because the idea is that we wrapped in this $1,000 into the APR amount. Now this APR is not going to be used in order to calculate the amortization table, because we kind of finagled this calculation. We kind of finagled, I don't know if you know that word, but finagled it. We finagled it in order to figure out, a comparison percentage that we could then compare to other loans that had possibly different interest rates and different closing costs, so that we have something that's more comparable. We'll talk more about the comparability in a future presentation. If I was to do my loan balance calculation, however, I wouldn't be using the APR. Instead, if we calculate this in our amortization table, we would start off with, instead of 100,000, 101,000. So that 1,000 right there is already included as kind of an added cost that we've already kind of paid up front, and now we have a higher loan balance, which we're going to pay off over the 30 years. And so then when we pay it off, we got our 672, which is the amount we calculated up here, about 671.96. And then when we calculate the 101,000, we're multiplying that times 0.07. The 7% divided by 12 gives us the 189. We're not multiplying it times the APR, but just the interest rate. And then the difference then is going to be the 672 minus the 589 gives us about the 83. And then we do our 101,000 minus the 83 and so on to get the 109.17. And if we did that all the way down, then we can do this all the way down, and we get to our totals down below. The bottom line number is 0, and we can compare this to our online calculator if we want to do it in the online calculator, which we said 100,000, 30-year months, 7% is the rate. And then we have fees, and we're going to say these are added to the loan fees. So I'm going to say we had 1,000 fees added to the loan, rework that, and then it gives us the amount financed, 101. The payment is the 671.96, which I think is what we had there, right? Let's go all the way back up. All the way back up. We've got the 671.96, correct. All the way back down. All the way back down. And then we had the total of the 360 payments is the 241,903. So if we total up all the payments, 241,904 versus 241,903, right? And then we got the total interest is 141,903 on the interest. Notice we have 140,904, and it's off by 1,000, I believe, which represents that $1,000 that you're basically adding into interest and costs, right? That $1,000. So we have to say this is the interest we paid, plus they tacked on that $1,000 that was over and above what we actually needed for the 100,000 that we paid off, and that's where they're getting this 101,903, I believe. And then all payments, 241,904 for all payments. 241,904 is the 241,904 here. So you can kind of double check it with the loan calculators. You can use the loan calculators, they're nice, but when you're doing comparisons and you're trying to figure out different things, especially if you add in like taxes and your property taxes and this kind of stuff, it's very nice to be able to populate this into an Excel worksheet so that you have so much more control to do things that are going to be unique to you and your particular circumstances, running different scenarios and so on and so forth. So I highly recommend taking a look at this and setting it up in an Excel worksheet. It's good practice.